Okay, so let's take a look at section B, size neutral relative strength strategies. And so in the two prior tests that we've done with the unrestricted portfolio and the country neutral portfolio, they were not size neutral. And since we found that the winner portfolios are typically larger than the loser portfolios, then we could say that the size might be skewing the winner-loser effect. Also, if you remember, the extremes of the winner and loser portfolios were smaller than the portfolios in the middle, and so the average firm was a bit larger than the extreme winner and loser portfolios. And so does that mean that momentum strategies are only profitable on smaller stocks, or that the effect is only attributable to smaller stocks? So to test that, we're going to control for the size of the stocks and try to put together a size neutral portfolio. And so just like we did previously with the countries, we're going to split up the stocks, rank them by size, and then put them into deciles. And then each of the deciles is split up into the past 6-month return deciles. And then each of the deciles are combined in a way that, for instance, the loser portfolio contains 10% of the firms with the lowest previous performance from each of the size deciles. And the same thing with the winner portfolios, where the firms with the highest past return from each of the size deciles is in the winner portfolio. And so that makes it to where each of the winner and loser portfolios contains the same number of stocks from each size decile, and that makes them somewhat size neutral. So it looks like panel B of table 3 shows the results of the size controlled portfolios. So let's go take a look at table 3, panel B. And so here, like we've seen in the prior tables, we have the winner minus loser returns with the standard deviation and the t-statistic for that mean. And also it looks like we have each of the size deciles split up to show the average return for each. So let's take a look at those. For the overall size neutral portfolio, we see that there is a return of 1.17% for the momentum strategy. This is sort of in line with the prior studies, as well as this one that finds about 1% return on average for the momentum strategy. And looking at each of the size deciles from smallest to largest, they're all positive and all about 1%, or even some of them a lot more than 1%. So we could say that the persistence of returns is not necessarily limited to a size of company. And there are even very significant t-statistics, so it's not likely that these returns are zero. It is interesting to see, however, that there is a almost monotonic reduction in return as the size of the company gets larger and larger, and there's a reduction in standard deviation as well. So the conclusion here is that across all different sizes of companies, the continuation effect certainly occurs. However, it does seem that the smaller stocks, the momentum effect is a lot more pronounced. Okay, so let's go back up to section C. Size and country neutral relative strength portfolios. So we looked at the size neutral as well as country neutral results of momentum effects separately. However, those attributes are certainly not independent. For example, the country-specific relative strength portfolios take significant size bets, and the size-sorted relative strength portfolios take significant country bets. And so here we're going to take a look at the effectiveness of relative strength strategies when they avoid taking significant country and size positions. And so to do this, ordinarily, maybe you would take, or you would make 10 portfolios for every size, every country, and every past 6-month returns, but we don't have enough securities to do that. So what we'll have to do is first sort all the stocks by country and into into 3 different size groups. So the small, the bottom 30%, the medium, the middle 40%, and large, the top 30%. And so within each of those groups, we will rank the stocks into deciles based on their past 6-month performance. So basically we've got 12 different countries, and within each of those 12 countries we will split them up into 3 sizes. So that makes a total of 36 different portfolio groups into which we rank according to the past 6-month returns, and we put those into deciles. So let's take a look at panel C, which shows the results of this grouping. And so here, just like the other tables, we have this is the all stocks that were size, country, and neutral, or size and country neutral that we discussed a moment ago. And it looks like the mean return was about 0.85% per month if you are to buy the winners and sell the loser portfolios. And that's with a standard deviation of 0.0221 and a t-statistic of 5.32. So that's a significant outperformance of the winner over the loser portfolios. And so we can see here in this section with the size neutral country portfolios, there's not really a particular geographical market that outperforms any of the others. So we could say that the momentum strategy is irrespective of geographical location. However, we do see, as we found in the prior table as well, that the smaller size companies in the portfolio seem to outperform the larger companies, and especially when we control for country bias. It looks like the small companies doubled the return of the large companies. And all of these results have significant t-statistics. So our conclusion here is that although there are variations in returns relative to geographical location and size, an investor really need not tilt his portfolio one way or the other according to country or size in order to earn excess returns with momentum strategies. It certainly does pay off to purchase smaller stocks, though. However, when you enter in transaction costs and liquidity, that might be a little more difficult as well. So let's go back up to section 3. We're now done with section 2. We're going to look at the risk-adjusted returns in the first section, section 3A, the adjustment for market and size factors. So it looks like panel A of table 4 provides the analysis and results of this particular section It looks like they didn't really explain much of what they did or the regression that they used, but I think that's going to be down in the table, so let's take a look. Okay, so table 4, risk-adjusted excess returns. Okay, so here we have a common regression where we've got the excess return of the portfolio over the risk-free rate, and this risk-free rate is going to be the Deutschmark. And here we have an alpha plus a market risk factor where we have a beta times the return of the market minus the risk-free rate. And then we have a size factor, which is the SMB is the return of the small stocks over the large stocks within an internationally diversified portfolio. And then we have an error term. So what we're trying to do here is see if there is in fact a return, this alpha figure, after we adjust for typical return calculation risk factors. And so if there is an alpha amount here, we could say that the return of this strategy is not caused by, or the source of it is not due to the general market return or the company's size. Okay, so let's look at the results here in panel A. And so our table here has a column for the alpha and t statistic for the alpha, and then the market beta and its t statistic, and then the beta for the size, the small minus big, and the t statistic, and then we have an r squared, which tells us the goodness of fit of this regression. And we see here this first section is a regression of just the market beta piece, and the second section here in panel A is a regression of the market beta plus the size beta. So looking at this, the first thing we notice with this first section is that there's the return of the alpha is 1.14%, so that's an abnormal return after accounting for the beta risk, which, since this t statistic of the beta, or the market beta, is so small, we could say that this beta figure is most likely 0. So we could say that buying the winner and selling the loser portfolios are really not sensitive to the market beta at all. And we see that this winner minus loser portfolio is very significant. Now going down to the second section, once we add in the size beta into the regression, our winner minus loser portfolio's return actually increases to 1.46%, and with a very highly significant t statistic. Since we see that this coefficient is larger than this one, we could say that the loser portfolios end up being more influenced by smaller companies, or at least factors of smaller companies, whereas the winner portfolios are maybe composed of more large companies. And so our takeaway here is that even after adjusting for size and market beta, which are typical regression techniques to control for risk-adjusted returns, even after controlling for those things, we still have significant alpha here. So we can say that all of the returns of the momentum strategies are not fully due to market risk or to size risk. Okay, so let's go back up to the discussion here in this section. So DeBont and Thaler and Chan also found that abnormal returns are associated with long-term return reversal strategies that disappear once betas are allowed to vary with the market. And so to think about this, in order for the return of a portfolio to be in line with the betas, then for instance, a loser portfolio would have had to have a higher beta during a bear market and a lower beta during a bull market to make it underperform the overall market, because it would have been more volatile during a bear market and lost more money, and it would have been less volatile during a bull market and it wouldn't have gained as much. So it looks like table 5 actually shows that the opposite is true. So let's take a look at table 5. So it looks like we have the same general table as before, although we have some added factors in here, or kind of revisions of factors. And we've seen this before in a previous paper that we read. So here's excess returns of the portfolio over the risk-free rate and the alpha. So we had before. This is what's different about this equation is we have a market beta piece for bull markets and for bear markets. This dt right here is a dummy variable, where during a bull market it's 1 and during a bear market it's 0. So in a bull market, this dt right here is 1, then the regression uses this piece. But since dt is 1, then this becomes 0 and cancels out this whole piece. So, and the same thing happens, but vice versa in a bear market. So if in a bear market, this will be 0, but this will be 1, so it will keep this piece. So anyway, in that way we can see what the coefficients in a bull market and the coefficients in a bear market. So it looks like we have first, this table is similar to the last, but panel A has the unrestricted relative strength portfolios from the portfolios that we built earlier in this paper, and panel B has the size and country neutral relative strength portfolios, and that was from the most recent section. Anyway, as before, we have the loser returns and the winner performs returns, and the winner minus loser returns. And for each we have an alpha figure with the t statistic and the beta of bull market returns, or market return during a bull market and its t statistic, as well as the market coefficient during a bear market and its t statistic, and then an r squared figure. And so it looks like the 1.99% return, the alpha seems to be very, very significant, very high, with a significant t statistic when we're controlling for the up and down market betas. And also to note, we see that the loser portfolios seem to have a higher market beta during bull markets, a lot more volatile during a bull market, and a lot less volatile in a bear market, which is the opposite of what we had conjectured based on prior studies. So in this case, it seems no matter whether a bull or a bear market, the loser portfolio will actually outperform the average market return from a nominal basis, because it optimally switches its volatility with market conditions. However, since this alpha figure is pretty much 0, then there's no unaccounted for return. And also, from the winner portfolio perspective, the beta is a lot smaller during a bull market and a lot larger in a bear market. So taking the loser and the winner portfolios into account when forming the winner minus loser portfolios, the beta of the no-cost portfolio in a bull market is significantly negative, and in a bear market, the beta is significantly positive. And all of these results are pretty much the same in the size country neutral portfolios, although the winner-loser portfolio alpha is a bit smaller. Okay, let's go back up to section B. Relative strength strategies and event time. So you remember forming the portfolios earlier in the paper, there was sort of an overlap of portfolios as the change in J and K occurred. However, in this particular section, we're going to hold the portfolios for the entire 6 months without allowing for revisions and small pieces of the portfolio. So it looks like table 6 provides the results for that. So let's go down to table 6. Yeah, so I'm going to have to zoom out a bit to get this entire table in here. So here we go. Okay, so here we have sort of the same regression as we've seen before, sort of a two-factor model. And we have the winners and losers should equal an alpha figure plus the market risk, which is basically the MSCI index of the 12 countries, and minus the Deutschmark risk-free rate. And then we have a size factor here, which, as was explained before, is the return of small companies minus the return of large companies, sort of split up at the median of size. And alright, the J in our calculation will be 6 months. So these in order to get the winner or loser portfolios, we used the past 6-month returns to determine the ranking. And then we have a K column here which shows the holding period from the holding period of the portfolio from month 1 all the way to holding it for 24 months. And so this is the average return if average return across all of the different portfolios if held for this number of months. So initially we can see that as we hold the portfolio for longer, the monthly return starts to go down. The first 11 months show an excess return of winners over losers, and then after that the returns seem to be negative. And we see that the T statistics, these returns are fairly significant. Interestingly, we see that the market beta is pretty much 0 across all of these months, and the size factor actually acts negatively toward the return. And we see that initially the abnormal returns to alpha are highly significant in the first 11 months, and then when the abnormal returns turn negative, their T statistics are pretty small, so we might conclude that we can't say that these abnormal returns after a year aren't zero. So it's more likely that there's not a reversal, but more just the stocks are now more in line with their fundamentals and the factors that we have here. And this result is very interesting because it's almost exactly the same as what Jagadish and Titman found in 1993 with just U.S. equities only. And so here we have nearly the same result across 12 different international markets. The only difference might be that Jagadish and Titman found the second year there's actually a reversal in returns, but here we can't really say that there was a reversal because we see that these aren't significantly different from zero. Okay, so it seems figure 1 shows us the cumulative payoff to momentum strategies. So here we have a figure that shows us the cumulative return of buying a winner and selling winner portfolios. That's this solid line here. So we see, as we found in the prior table, the cumulative balance or return goes up for about 11 months and then sort of levels off. And these dotted lines, we have a 95% confidence interval. So we could say that we're 95% confident that the returns of buying winners and selling losers in the international markets would accumulate somewhere between 5 and 18% over a 24-month period. And most of that was built in the first year and then leveled off over the next year. And so even after accounting for transaction costs, which could be anywhere from 1 to 4% of the returns, even accounting for that still gives an abnormal profit by using this strategy. Okay, so let's go back up to section C. Are there common components among European and U.S. momentum strategies? So in Jagadish and Titman's 1993 paper, they found that momentum strategies were probably caused by a delayed price reaction to firm-specific information. And so if it's due to firm-specific information, then if you buy a portfolio of more than 200 stocks or a very high amount, then those idiosyncratic returns and risks should be diversified, and the standard deviation should not be very large. But since we found pretty high standard deviations per month, then we could say that these strategies are not perfectly diversified. And so in that case, there could be some common factors or components across markets that are being used in these portfolios. So to see how pronounced that effect is, we're going to take a look at the correlation between European and U.S. momentum returns. So initially we found the correlation between the country-neutral European portfolios and the U.S. Momentum returns to be about 0.43, so that's a pretty high correlation over the 1980 to 1995 period. And so to kind of dig a little deeper, we do a regression to evaluate the profitability of the European strategy conditional on the U.S. experience. So here we're trying to find basically the source of the winner minus loser returns in the European markets based on the winner minus loser returns in the U.S. market as a factor. So if we found that there's a high t statistic for this coefficient, then we might say that the U.S. market's momentum strategy influences the return of the momentum strategy in the European market. And if this alpha term has a low T statistic, then we could say that the U.S. market's momentum strategy fully explains the European momentum strategy. However, what we do see is that T statistic is fairly high, so we conclude that the European momentum strategy returns are not fully explained by the U.S. momentum strategy, but instead there are some other components or factors that cause that return in the U.S. and the European market. We do, however, see that the U.S. momentum returns do have somewhat of an influence on the European momentum returns, with the T statistic being so high. But of course, this is a pretty simple regression, so there could be other factors at stake, for instance, the size and the market betas that we explored earlier. So let's conclude on the whole paper here, section 4, the conclusion. So in this paper we were exploring the momentum returns in 12 European countries and at the individual stock level. And we found that an internationally diversified portfolio of past winners outperformed a portfolio of past losers by about 1% per month. And we also found that common risk factors such as size and market are negatively affect the momentum returns. Therefore, these results go against the efficient market hypothesis as well as commonly used asset pricing models. And a pretty neat finding, the momentum strategies work across all 12 of the countries that were studied, and it doesn't really it's not largely dependent on how big or small the companies are, although we did find that the smaller firms are more affected by the momentum strategies and have larger returns. And even more remarkable, this study was almost identical to Jagdish's and Titman's study in 1993, which was exclusively over the U.S. market. So we find that maybe the U.S. market momentum strategies are not just a fluke, and that this momentum strategy works across all markets. And it seems that the returns of European momentum portfolios are highly correlated with the relative strength strategies in the U.S. So there seems to be a common factor across these markets that's causing those momentum strategies. But that may be something that other researchers can look at in the future.